What up, investors? I've been on a hunt lately to find good deals in the banking sector, the financial sector, after some of the regional bank crisis fallout during March and running onto this month as well. So naturally, I stumbled on Citigroup again, although that's not a regional bank. I did make a regional bank video not too long ago about Regions Bank, so go check that out. This one's going to be about Citigroup. And when I dug into Citigroup, I found out that this company is an absolute fortress. Okay, first of all, it's a behemoth. It's a large financial conglomerate, basically. It's very diversified among its client base, not just the type of clients they deal with, but they're also diversified globally as well. And they're also diversified within each part of their business. Now, let's start with the price. Okay, first, we're going to take a look at the company. Going to do a little bit of an overview. I'm going to do a tiny bit of a deep dive on their 10Q and their report. And then see if we can draw some conclusions about how risky it is to invest in Citigroup and whether the current price makes sense or not. Now, I'm going to be using stockanalysis.com for this analysis. The site is free. You can go ahead and use it, and it's pretty accurate. The numbers on there are pretty good. I'm not affiliated with them. They're just a good site to use. I like to use it. And also, if you click under the profile, you will notice that they have a bunch of SEC filings down there. You may have to see the whole list and try to find the 10Q in there, because for some reason it's listed the prospectus like 500 times. That doesn't happen normally with all companies. Okay, just for some reason it's doing it. Now, Citigroup, like I said, is diversified, and some of the geographies they work in is North America, which comprises about 56% of their business, then Latin America, Asia, Europe, and the Middle East and Africa. So they have two big wings, GCB, which is Global Consumer Banking, and Institutional Clients Group. Now, I think the Institutional Clients Group is actually about twice as big as the consumer banking side. So that gives you an idea of how much they care about the consumer side of the equation. But they do offer quite a bit in there. I mean, we've all seen their credit cards, right? The Citi credit cards. So they do offer all kinds of banking services and credit cards, retail services, etc. It also provides banking, lending, investment services. I know they have wealth management as well. So all that. Electronic delivery systems, okay? Now, the one thing that stops my eye immediately is this dividend. So I wanted to research to see how safe the dividend is. What's their history of paying dividends? How are they managing that side of their liabilities? And the other thing that I'm noticing here is the price to earnings ratio. Of course, it's pretty low. It's a bank. They better be earning some money. The market cap is $90.5 billion. Revenue is not that high. The income, of course, is very high. We're going to look at the financials next. My favorite tab. But before that, two other things I like to look at the first page here on the overview is the price target for analysts, which is going to be 21% higher than it currently is. I don't know if I necessarily agree with that, but we'll take a look. And then this little square here just gives you a quick overview of how the company's been doing over the years in the past. So it looks like they just missed 1 year when it comes to profitability in 2017. All the other years have been pretty solid, including 2020. Including 2020, guys. So that's pretty good. All right, my favorite tab. Okay, we're going into the financials tab. I'm going to do a quarterly breakdown of the figures because quarterly just gives me a more of a definition on what the company's been doing quarter to quarter. Sometimes the yearly figures can be deceiving. We're going to start with the revenue. So revenue coming in strong. They actually had their highest revenue quarter this last report at $21.45 billion. That's not bad. Good revenue. So if we annualize it, right, that's like over 80 billion a year, which is great. Moving down, then I'm just gonna skip all these. Going into net income here, the second most important figure, I think, or the number one most important figure for a bank. $4.61 billion in net income for this last quarter, coming up from 2.5 in the previous one. So really strong. Next one, shares outstanding. So this was kind of important for me, okay, because I wanted to relate this to the dividend. I wanted to see how they're managing the dividend payouts, and it looks like they're also buying back shares. Now, some might think, okay, this is important here. Some might think that they're basically paying out money on both ends and they're depleting their cash reserves like that, but it's not quite like that. They kind of cancel each other a little bit, okay? So what I mean by that is if they keep buying back shares, there are less shares outstanding out there, which increases the ownership portion of the company to shareholders. But that's not all. It also decreases the total amount of dividends they have to pay out. Right? So you see how it works? So let's say, for example, I issue 100 shares. Slavian. Okay? Where is it? Company Slavian issues 100 shares. Okay? And I decided to pay a dividend of $1 each on each share. So that would have to pay $100, right? $1 per share to each one of the shareholders, to whoever owns a share. Now, next quarter, let's say I buy 10 of those shares back. Okay, I buy 10 shares back. And yes, I have to put that money out. But now I don't have to pay $100 in dividends anymore, right? I only have to pay $90 in dividends. And you see, so my cash flow kind of improves that. So this is exactly the interplay that some companies choose to do in order to be able to keep raising the dividends without fear, right? Their cash flow. So look for example what happens here. So we got the shares outstanding. It's going down, right? They've reduced it from 3 billion back in 2014 days all the way 8 years later to 2 billion. And dividends per share has actually been rising, right? It's been pretty flat actually since 2019. But let's take a look at, is it the cash flow here? Dividends paid. Look at how since 2018, so they had these massive increases through these years. But now since 2018, the dividends paid out is actually it's decreased. And it's precisely because they've been buying back shares. So now that dividend paying liability is less, okay? So that's how they do it. So that's pretty commendable. Here's the dividend history. We've got 51 cents for quite some time. Then before that, 45, 32, 16 cents, 5 cents, 1 cent, 2013. So they haven't raised their dividend for quite some time, but pretty sure soon they will start raising it again if good times come in. And I think they'll decide at a good time to raise it by a little bit. Now, we're going to do a full circle here. Have we finished the financials? Let's see. Profit margin, around 20% standard for a bank. Okay, let's talk about price for a little bit. Let's pull out the year chart, okay, and see how this Citigroup bank has done during this little regional bank crisis, okay? So we can see that over here in March, the price of the stock went from low 50s to low 40s. Okay, so about 51.5 to about 42.5. Now it's been hovering around in the mid 40s. So this is the kind of percentage that's like 20% down. Okay, 20% down. Not too bad. How about let's see how it handled March of 2020. From 69, so pretty basically $70 a share, all the way down to 33. Down to 33. So that's over a 50% drop. That's awful, but it's basically in line with many other stocks out there. Okay, not too shabby. But this decrease here, the company bounced back eventually once the money starts flowing in again. But this decrease here doesn't even hold a candle. Okay, are you ready for this one? I'm gonna pull it out. Don't get too scared. Okay, check this out. Doesn't even hold a candle to this. Look at this, guys. This is March 2020 right here. Oh no, $70. Boom. Okay, 50% drop. That's huge, but this is huge. Okay, Citigroup being worth $400 and then going down all the way to 14. Now that's a hit. Okay, global financial crisis. Now we're talking. That's like almost 100% drop. Okay. So ever since then, they've kind of, learned some lessons and they've improved their operations. And I'm going to take a look at how safe this company really is. To find that out, I went into the 10Q to try to figure out if I can glean some information there. Now, there are these assets called CET, Common Equity Tier 1 assets, which are the most liquid assets based on banking regulations. And I also looked at some of the not for sale hold to maturity assets. Basically, they're not allowed to sell, and I wanted to see if they're going to be a problem when it comes to their asset side of the equation here, if they ever need to liquidate in order to meet deposit demand. So far, deposit demand has not really gone crazy. I think they've lost like maybe $3 billion worth of deposits, but they have well over $1 trillion, last year and this year. So it's basically not changed at all. 3 billion sounds like a lot, but it's actually completely insignificant when you look at some of these numbers. And these numbers are huge. Let's take a look at how huge these numbers are first before we go into the 10Q, okay? Let's go to the balance sheet here. Quarterly. All right, cash and cash equivalents, 328.96. Not bad. Let's look at total assets. Look at this huge number. Do you see what it says? 2,455.11 B. That's 2.5 trillion, guys. 2.5 trillion worth of assets. Total liabilities, 2,246.09 billion. So that's 2.25 trillion with a T. Trillion with a T. Which leaves us with 208 billion shareholders' equity. Perfect. So here I am. In order to find the 10Q, I told you can go to the profile, scroll down, SEC filings, look for 10Q. But here I go. I clicked through and I found their consolidated balance sheet. So I just wanted to find out how much of these types of assets are they really holding, because the held to maturity, right, was, I'm sorry, I didn't show you the graphs. So here it is. Assets, 2.45 trillion. Okay. And total liabilities, 2.246 trillion. I'm sorry, 2.246 billion. So that's 2.25 trillion. All right. And here's the shareholders' equity. Okay. So these held to maturity deposits, held to maturity debt, securities, are the ones that were causing troubles for the regional banks, and I wanted to find out whether that's going to be a problem for Citibank. So under this consolidated balance sheet, I found that under investment, they have available for sale debt securities, okay, of $240 billion. And their held to maturity debt securities, net of allowance, is 264. So it's a pretty even split. I mean, this is not really worrisome. And it looks like their CET1 assets, right, the common equity tier 1 assets, hover somewhere between 10 to 13% of their total portfolio. And the banking regulations only requires like 6 to 8%, depending on what time frame you're looking at. So really, they're pretty well capitalized. They're controlling their debt really well. They are good on regulation. They've got size. They have plenty of shareholders' equity. Then on top of that, they're maneuvering their dividends pretty smart. You know, they're buying back some shares in order to decrease their dividend liability a little bit. And I'm sure they're going to increase that dividend over time. So they're controlling their capital, I think, pretty well. The bad part about Citi, though, is that not much has changed, like since last year or the year before that. It's kind of growing a little bit. Oh, there's some interesting things actually in the 10Q. I want to show you this, but it's not. I'm just going to show you my face when I look for it. But it's not actually bank. Well, it is related to Citibank, but it's not that much related to the banking as much as it is related to like global economy and what we can glean when it comes to what the direction of the markets and the global economy. So here's some interesting statistics from their 10Q. I didn't even know they put this in there, but I'm going to show it to you right now. So over here on the left is some of their consumer credit trends. Okay, consumer credit trends. So personal banking and wealth management on the left, up. Retail services here on the right. I know you can't see the left side very well, but it's hard to adjust the frame for everything. So retail services, look, up. Do you guys see that? Up 4.08%, up 1.76%. Branded cards on the left, up, going up. The business increasing. Right? Retail banking, increasing. Ever since 2022, mid-2022, all these things are increasing. The only thing that seems to be decreasing is global wealth by 1 tick in the first quarter of this year. But it's about equal to, the global wealth at Q3 2022. So not much action there, honestly, but you can interpret this last line down as a negative. But Mexico consumer, up. Okay, so all these charts really are showing like more consumer like credit utilization. Now you can think that that's a positive or a negative. You can take it as a positive and say, oh, well, the consumers being more active because they have more confidence in their earning ability and they're spreading their credit card a little further and saying that, that's really good for the economy. I mean, and just that money spent is actually going to put more money in other people's pockets and they're going to feel more rich and it's going to be a virtuous cycle up. The only downside to all this is that I looked at their the credit rating for the consumers that are doing the spending of their credit cards, and it looks like it's deteriorated a little bit. So perhaps it is increasing because the standards that Citi accepts in order to hand out credit cards has been decreasing by a little. Now, I can't I'm not gonna scroll through the 10Q to find the exact part where it mentions all that, but you're just gonna have to take my word for it, or I'll try to put a link in the description or the comments of the 10Q so you can look at it yourself, or just Google it and you can scroll down and figure out where all that is. So basically, what is my conclusion here? The conclusion is, let's see if I can see any cool trends here. Oh yeah, there it is. Actually, I'm right here. Let me show it to you. So you can see on the right, if you have a desktop, you can probably see it better. This is going to be uploaded in HD, so you should be able to see it. But if you're on the phone, I'm sorry. I'm just sorry. But here it is. So FICO distribution, FICO, the credit rating agency. So consumers with over 760 credit rating in December of 31st, 2022 and in March 31st, 2022, 48% of credit card holders were 760 or above. So that's good. 760 or above is really good. However, in March 31st, 2023, this latest quarter, only 45% were with such credit rating. So either credit rating of the people who are holding the cards currently has deteriorated, or there's been an influx of lower standard consumers penetrating this credit card market. Credit rating 680 to 760, the next tier down, has stayed steadily. No change here, more or less. 680 credit rating and below. So this is like bad credit rating. Okay, 680 or below is bad. Like I think 680, it's rarely can you get anything done with if you don't have at least 680. So it looks to me, right? It says 32% this March. So 29% in March 31st, 2022, a year ago, versus 32 now. So 29 last March, 31 this last December, and 32%. So the percentage of 680 and below consumers is increasing. It's increased by 3%. Oh, I'm sorry, I'm looking at the wrong one. That's retail services. I'm sorry. Branded cards. Okay, my bad. 13 to 16, it's still the same. It's 3%. It's just the numbers are a little off, my fault. So 3%, so 13, 14, 16. 13% in March 31st, 2022 versus 16% in March 31st, 2023. So we lost 3% from the highest rated group, and we've gained 3% on the lowest rated group, and virtually unchanged in the mid tier. So you can that could foretell that either people are losing their credit rating, or the standards are decreasing, or whatnot. But you could take it as a worrying sign in the economy instead of a hopeful sign that shows credit activity increasing. So I thought that was interesting, that they would put information like that into their 10Q. But as far as the company goes, I think I'm gonna judge the company based on the dividend actually. So the dividend is paying about what was it? Let's go to the dividend here. 4 point, sorry. Let me show you. 4.39. Put an overview page. Oh yeah, 4.39. Okay. And so that's basically I think the benchmark here that needs to be met. Currently, if you just leave your money in the money market account, right? In most money market accounts, you get like 4.5%. So it would need to clear that mark, the dividend would, in order for many people to be worth buying this bank and taking on the additional risk to get this type of dividend. Now, the yields are inverted, and so that means that locking in a 4.39 rate for the foreseeable future is actually a really good deal. And people who say that have a great point, especially with a company that's such a fortress, right? A company that's so strong, that has trillions of dollars in operation, literally. A company that's got many, many, many billions of dollars, hundreds of billions of dollars that they could use to satisfy any kind of modern bank run that happens, and can handle quite a bit of asset markdown. So I think the company is very strong, and the only problem is like if you buy this, you are kind of putting yourself in a bucket of where you're not going to be gaining much appreciation over the long run. Like there's no real upside surprise potential in the stock. It's just like buying a bond or something like that with a little bit of tiny more risk. So that's how I would play it. I wouldn't try to get too much price, although it could happen, but I highly doubt it. I mean, things are pretty stable in this company. And if you want price appreciation on the stock, there are probably other options out there. So hopefully that helped you shed some light on the company. I had fun researching it. I've been diving into banks and financial institutions now to try to look for deals. Like I said, I did RF. I did US Bank not too long ago, USB, so check that if you want. And I plan on looking into some more financial companies in the future to see if I can find something that I like. I actually sold 10 puts on RF, on Regions Financial, I think it was called, after looking at it. And it's probably not the best bank out there. It has its own risks. It's a regional bank, but if you want to check that out, you can too. And let me know which ones your favorite banks are right now, or financial institutions, because I'm looking at some and I want to buy some, but I have no idea like which one is actually the best. So I've been going one through one, but I definitely want some ideas. So if you have an idea of a bank or something that you want me to look at, please write it down in the comments. All right. With that said, peace out. Mic drop.